Hi there, my name's Giles, Macro Strategist at Seasonax, and welcome to another seasonal deep dive. Now, today we're going to be exploring a well known and often debated market phenomena called the January effect. And this is the idea that stock prices, particularly smaller stocks, tend to outperform during the first part of the year. So, what exactly is the January effect? It's a seasonal tendency for stocks, especially small cap equities, to rise more than usual during January. And the theory dates back to prior to 1950 when researchers noted that stocks would often make outsized gains at the very start of the year. And over decades, this pattern became a very well known, observed, and traded calendar effect in global markets. So the question is, why might the January effect be in play? Is there any sort of fundamental reason for it? Well, some of the explanations that are given are one, tax loss selling, that investors are selling losing positions at the end of the year to realize tax losses, which can then temporarily depress prices in December. And then when the new tax year begins, they can reinvest, and that tends to push prices higher in early January. Sort of similar reason to the reason you see the dollar moving lower and higher at the end of the year. If you just take a look at the Dixie, you can see how the dollar falls lower into the end of the year and then picks up at the start of the year. That is for an accounting reason. So that's part of the reason that's given for the bias of small cap stocks to raise prices at the start of the year. There's also year-end optimism, the Santa Claus rally, that fresh start of the year. It can just generally lift sentiment. Portfolio managers reposition for the year ahead. There's a bit of a general buzz, and that's also given as a reason for the January effect. There's also an explanation of bonus and pension inflows. Fresh capital enters the market. Investors are allocating their year-end bonuses, maybe savings, and they just invest potentially into riskier, higher beta stocks like small caps as the market benefits from that optimism and risk-taking perspective. So the bottom line is that January tends to act a bit like a reset button. It combines liquidity, sentiment, and positioning effects all into one little package. And that's probably the best reason and explanation that there is for this so-called January effect. So where can you see it? Well, it's often particularly seen in small cap stocks. For example, if you look at the Russell 2000, I've got here the iShares Russell 2000 ETF, you can see that from the 3rd of January to the 16th of February, there's an average return of 3.86% in the first part of the year, from the 3rd of January to the 16th of February, an average return of 3.86%. And you notice that the gains tend to move in those first couple of weeks of January. You get this initial tick higher, and when you look at the S&P 500, you can see that the small cap stock gains from that's that sort of early part of January into the middle of February. In the Russell 2000, it's 3.56%, and that's greater than the increase in the S&P 500. So there is a bias for small cap stocks to have more upside on average over this 15-year period. Now, let's be clear, while the January effect does have strong historical backing, it is not guaranteed. In some years, you get macro headwinds or tight liquidity, and that can completely reverse the pattern. If you look here at 2022, you can see, look, the average move was, the move for the year rather, was negative 11.05%, the maximum drop, and it was a total fall of 4.10%. Now, if you look back, and you can remember back to 2022, we saw a very big move higher in bond yields, and you can see the federal funds rate was moving higher. So the Fed were hiking interest rates, and there was a sharp move higher in bond yields. as the expectations of higher interest rates was weighing on stock markets. And you can see that pressure, which markets were strongly expecting at the start of the year, did weigh on small cap stocks, and they weren't able to make their usual gain. So while the January effect is real in a statistical sense, just to be aware, it's not a free lunch, and each year's context really does matter. Now, market wisdom, like the January effect, can be a great starting point. And if you look at the DAX, you can see January, an average return of 2.18% from the 6th of January to the 26th of January. Nice early start to the year. Euro stocks, average return of 1.92%, 60% winning trade percentage. Again, notice 2022 was a negative year. FTSE All Share Index, you can see first couple of weeks of January, average return of nearly 1%. And you see some of the January effect turning up in commodities. Gold tends to have a strong start of the year. Platinum has a really strong start of the average return of 3.07% over the last 25 years. So, the January effect, it can be a great starting point to consider positioning at the start of the year. But it's only really the data that tells the full story. So at Seasonax, you can test these patterns and the received market wisdom across thousands of instruments, stocks, indices, commodities, and currencies to see where the edge really lies. So whether it's the January effect, the turn of the month effect, even the Santa Claus rally, Seasonax's data can help you move beyond market folklore and myth into evidence-based trading. Go along to Seasonax.com to discover your next trade idea based on true seasonal probabilities, and you can start the year with the data on your side. Thanks for watching, and I'll see you in the next seasonal deep dive.